Welcome to the Royal Family Real Estate Podcast, where none of us are shy about giving our opinions. We are a local, family-owned real estate brokerage and pride ourselves on being experts in the Chicagoland area. Join us on our podcast journey to hear what's going on in our local real estate market, as well as get an insider's point of view on this crazy industry. Welcome to the show.
Hey, what's going on, friends? Welcome back to another episode of the Royal Family Real Estate Podcast. We're excited today to be able to talk about building wealth through real estate. I'm excited to be here today. Obviously, I get to talk with Royal Hartwig again, but today talk about building wealth through real estate, which is something he's really done over the years. Not only a top agent in our area, but he has used his resources to be able to not only invest in and make really strong investments in his own portfolio, but also to help many people be able to invest and to be able to maximize their ROI when investing in real estate. So looking forward to getting the knowledge out of him so that we could pass it on to all of you out there in the community, that whether you're a broker or whether you're somebody that wants to just get into investing, today's podcast is really going to get into like how to get started and why to be able to get started and be able to go from there. So enough of me talking. Mr. Royal Hartwig, what's going on, man?
Oh, living the dream.
Living the dream, man. We're talking about building wealth through real estate. I think that's something that you really enjoy.
I love it. Yeah. I love it. Yeah. I mean, if we're at a party and I'm quiet, just ask me something about real estate and I'll start talking. So I do love real estate.
And your wife will walk away. Yeah.
Yeah, pretty much.
Yeah.
I love real estate. I've got property of my own and I bought a bunch in the past, and I've sold a bunch too that I should have held on to. But we'll talk about it, that it's not just a passive investment. You really gotta work at it.
It's definitely work, but it allows you to diversify, right? Mutual funds are great, stock market's great, but real estate is also great, especially if you're looking at it over the long term. Yeah. If somebody's looking to be able to get started in real estate investing, where do you think where does it start for you? Like what knowledge should they have going into that process?
Yeah, so there's a lot.
Start with the very basics and we'll kind of build up into that.
Yeah, for sure. So and because there's a lot, what I like to do is just set up a time where we can come into the office and talk about it. And because I'll get calls that they want to invest in real estate, and most of the time it's someone that wants to do just a one-off, or do something for the kids' college, or have diversified real estate in their portfolio, but not someone who wants to be buying hundreds of properties. So usually they're just at a starting point, which is great. And so what I always like is we just come to the office and really sit down and go over everything. And the thing that really sheds light on whether or not they want to do this is when I like to start out with the cap rate spreadsheet, which stands for is short for capitalization rate. Mm-hmm. So basically the return on the investment, the ROI.
Which makes sense. Does this even make sense for me to be able to invest with what I have?
Right. Yep. Yeah. Before we go into all the great things, let's find out if this is even something that you feel makes sense financially to do. And so I'll pick a property that's currently on the market. Get an idea of what the rent price is, what I think we could buy it for, and then factor in all the numbers that are on there. Taxes, insurance, if there's an association, whatever maintenance I project on there per year, and utilities if you have to pay them and whatnot. But most of the time that's not the case, but multifamily you would. But anyways, those are all things that I put together in this spreadsheet. It's a very simple spreadsheet where anyone can really look at it, make sense of it. Mm-hmm. And then I don't factor in mortgage because I like to look at a straight cash basis. Not to say people are going to buy it straight cash, and I'm not advising that. But from when you look at it from the return on the investment, that's where you can really get straight to what the return on that cash is. Mm-hmm. And you want that to be higher than the interest rate. So interest rates right now are at 6.5%, 7%, and we're September of 24 right now. So if it's an investment property, typically it's going to be about at least a half point higher that the interest rate's going to be. So if you've got a 7% interest rate for primary residence, it's going to be maybe 7.5, 7.75 for investment. So you have to, because people will sometimes look at what interest rates are, but really not factor in it's going to be higher.
Sure.
But you want the ROI, the cap rate, to be higher than what your interest rate is, and that's where you.
So
start,
it's an actual investment, then.
right?
Yeah,
So it's an
right.
investment,
Yeah.
and that's where you start to lose people because if they're really looking at the numbers, because you might find that on average you're looking at a 5 to 6% cap rate. And that's at least in this area, northwest suburbs. Now you can find areas that you can get a 7-8% cap rate. But the thing to keep in mind is that the higher the cap rate, typically the more risk there is. So you might be looking in an area that there's not as many people that are wanting to buy in that area, or might be harder to rent, or there's some reason that it's a
better return.
7, 8, or 9% cap rate. It's not just magically you found this gem. Okay. It's because the higher the cap rate, generally the less attractive of investment it's going to be for the broader audience. So usually you could pretty easily find something in the 5 to 6% range. And if you're paying 7.5% on a mortgage, I just don't see how that makes sense right now. Now that made a lot of sense pre-COVID when prices were low and interest rates were 3.5%. You could make a lot of sense out of buying an investment property. Pre-COVID, prices weren't going up the way they
are now. Yeah.
the way they have been, but I think we've kind of hit a stabilization point.
So to kind of recap, if you're looking to get started in investing, it really kind of starts with your why. Like, why are you looking to do this? And then do you have the resources?
Yeah.
From there, in the resource, I think is going to tie into this. You're looking at what we call a cap rate spreadsheet, which is really going to look at your rate of return to make sure that what you're going after is a good investment.
Yep.
On this spreadsheet is what you could get for it for rent, what you're going to pay for the property, and then all your expenses.
Yep.
Correct.
Yep.
So your maintenance, your HOA fees, your taxes, etc. Right. You're looking at it from like a macro perspective, and you're looking at it. So like, does this make sense to be able to go out and invest at this time with a property that is I'm gonna have to buy this for this amount, and then I'm gonna rent it for this amount. So we have that piece there, and we go from there. What other benefits are there? And I know there are some. What other benefits are there to real estate investing? Obviously, making sure you have a good rate of return, but what is there anything else that helps with making sure people are maximizing their dollar?
For sure, but maybe I could just dip into, we find out, okay, is this a good investment? And then we talk about location. Where do we want to rent? Because people will say, oh, I'm a very broad area. I'm good with going to, we're in Schaumburg. I'm good with going to Naperville or Oswego or Woodstock. And because they see great properties available at higher cap rates, maybe in those fringe areas. And Naperville's not a fringe area, but like Woodstock certainly would be. But what I always recommend is find a place close to home, with your first place at least. Get the feel for how this goes, because you think you're not going to be going to that property very often, but you are. Okay, it's going to happen. You're going to go there, especially when you first buy it. You're going to have to go there to do certain things, or get it ready for, or maybe meet renters there, meet handymen or woman, painters, whatever. Like you're going to be going to that property a lot more than you think.
People want to say passive income, but it's not that passive, especially in the beginning.
Yeah.
There's some sweat equity that comes along with real estate investing. Right?
From a IRS standpoint, it's passive.
Yeah.
But from an actual reality standpoint, it's not passive at all. And that's actually why I've sold properties and not held them. If it was completely passive and I didn't have to do anything, I mean, I could have had a management company do that work. But the biggest pain point for me was always when a new renter came in. It's just so much work that goes along with getting the right person. But there's work that goes into it. So I've always kind of hit a threshold where it was like, all right, I got to sell some, and the market's been good, so I've been able to cash out. But, you get to a certain point, especially that it really starts to become demanding. One or two, not a big deal, especially if you get great tenants in there.
Mhm.
It can be really easy. But it depends on the tenant, and you never know when you're going to get a call. So location is really important. I say try to get something that an area, something that's close to home, and that you have a really good understanding of that area, easy to get to, not that draining if you have to keep going there or something comes up. The type of property will always be something that we'll talk about. So single family or attached, like a condo or townhouse. Now, the thing with the condo or townhouse, you have to make sure it's rentable, because a lot of associations won't allow rentals, or if they do, it's only 2 family members, or you have to live there for a year or 2 before you can rent it. So that's a really important piece to make sure the rentability of it, if it's attached, which I really try to get my first time investors to buy an attached property. All of mine are attached. Yeah, they have associations.
Less risk though, because there's the bigger stuff, right? Or what's your reasoning behind it? Like the roof, you wouldn't have to exterior maintenance. Usually you don't have to cover on those types of places, but
half of the things I don't have to do.
Yeah. There you go.
That's a beautiful thing.
Yeah.
The association kind of takes care of all that. Plus they keep the tenant in line in terms of making sure that the tenant's doing what they need to do. So I like that. Yeah, it can be annoying when the association calls you up and says that, your tenant has a barking dog that the neighbors are complaining about. But, those type of things don't happen too often and they get solved. And yeah, there's the usual, whatever association is annoying, but paperwork you have to go over. But for me, I like to have as much hands off on the investment as I can. And that's what an association does for me. Typically the price point's a little bit lower and super easy to rent. Single family home, you're going to have, you have to worry about them cutting the lawn, doing the maintenance and
shoveling the snow,
and just a whole bunch of extra that could 50% more things that can come up. So that's why I try I said, let's just start here. And then if you really enjoy it and feel like this is something you want to do, then let's buy another one. But try to just get rid of that learning curve on something super simple, super close to home, so you can see if this is even something you want to do.
Yeah.
And single family is great, but there's just a lot more that goes along with it and a much higher price point.
I think it's a great approach. I think I feel like real estate investing is like the shiny thing right now in our world. Bigger Pockets is an investment brand that podcasting, web shows, and blogs and all of that, and how to teach people to be real estate investors. Well, that's made everybody and their mother want to be a real estate investor, right? Whether it's flipping or whether it's rent and holds, whatever that would be. But it's not glamorous as maybe they tend it out to be. It could be hard work. So starting off small and kind of chiseling your way upward, I feel like that's really good advice. And then do you see people get to a point where like maybe have people manage the properties and that type of stuff, or how does that usually, what's your recommendation there? Like if let's say they bought one property, it worked with them, they bought 2 properties, it worked with them, and then they continue to go, like, is there a certain number that when people could maybe flip it over to being able to have a management company help them support their real estate endeavors?
I think
investment endeavors.
It's you have to have some scale before you can get to that point.
Sure.
So you can have, and I've had clients that, have had people manage their property when they only have a couple or one, because they just don't want to have to worry about it.
Sure.
There's still going to be money coming out of their pocket, but they're just not the one, that's managing all of that. So I think you'd have to get to, a sizable amount before you do that, because once you do that, you might be looking at 6 to 10% in terms of a management fee and what that management company does. That's, straight off the
profitability expenses,
and that lowers your return on the investment. So, I've always self-managed mine because it's easy. I'm in the office every day and we're all things real estate. So it's been simple. But there's a certain point where that would make sense. But I think from an individual standpoint, it's hard to make sense of that financially.
Yeah, that makes sense to me. We touched on it. You mentioned the IRS earlier, and being a real estate investor does have tax benefits, right?
Yeah.
You talk to us about what you know about that. I know you're not an accountant, so it's just put a full disclaimer out there right now. But you do have experience with this. So with the tax benefits, what are those from your experience?
So, when you buy a property, let's say it's, and I'm not an accountant, so I'm probably getting these numbers wrong, but roughly, you buy a $200,000 property, maybe a 2-bedroom, 1-bath condo, and you can depreciate that for 27 and a half years. So you've got $200,000 property, and then you can depreciate the building on that. So not the land cost, but the building. So maybe the building is, let's say, 170 in terms of what you can depreciate. Divide that by 27 and a half years, whatever that number is, that's what you can depreciate on your taxes every year. So depreciation means that if you showed a $4,000 profit, but then you depreciated it at $4,000, you essentially, it's showing the IRS you didn't make any money. So you don't owe any taxes on that $4,000. So that's the beauty of, and so you can imagine if you have lots and lots of real estate, you're having lots and lots of properties that you can depreciate, which in effect lowers what your taxes are to, could be zero. But the other side of that is when you sell the property, you have to pay that back. Okay. So, this might be getting too into the weeds, but if you've got that $200,000 property that you bought, and just making it easy, let's just say we're depreciating it off the 200,000, and then you sell it at 300 someday, but you've depreciated that from 200 to 125. So now you've got $75,000 in depreciation, in addition to a $100,000 gain. You're having to pay taxes on a $175,000 gain. Mm-hmm. So that's something that, whenever I get someone who wants to sell an investment property, I'm always digging into that. Okay, have you been depreciating this every year? Do you know what your basis is? Because your basis would be, okay, we've depreciated it down to 125, and the accountant would know that. So that's a sizable tax bill. It'd be like, all right, if I sell this for $300,000, I'm going to have to pay taxes on $175,000. Okay, that changes people's mind. Where it's like, I don't do that.
Yeah, and you definitely could, because all of a sudden it doesn't make it a good investment anymore, possibly, right?
Yeah.
In some circumstances.
But the beauty, just to tap it real quick, is that if you pass that on to your heirs, and you sell it at 300, from my understanding, that now the IRS looks at what you bought it at, the heirs, as 300. So they sell it for 300. There's no depreciation that's owed. So you can eliminate all that depreciation if it's inherited. Mm-hmm. So that's a huge tax benefit.
I'm buying property as an investor. I pass on, and I'm going to give it to my kids. They don't have to pay taxes. That's what I hear you saying, correct?
Yeah, from my understanding, yeah.
Yeah, that's what I understand too. And then let's say if they do want to, they don't want to pay taxes right now, but they want to continue to invest, but they know that they've probably gotten the most they could get out of this house, or they want to move on to something bigger, whatever that is. With a 1031 exchange, how much experiences have you had with that, and have you seen out there? Because that helps you negate the tax bill too, correct?
Yeah. So let's say you, in that same example, you've got this $300,000 property that you're selling, and you've depreciated it down to 125. There's still that $175,000 taxable event, but now you sell it and you buy a property that's equal or greater value. I think it's equal or greater value, but definitely greater value. And you do a 1031 exchange. So you sell yours at 300. It has to go into an escrow account that's held there. So you don't get any of those proceeds. All that money goes there. And then you buy another property within a certain period of time. I believe it's 6 months. And you have to identify a certain amount, I think 3 properties within 90 days. So you close on that one. I believe it's within 6 months. and it's a $400,000 home, then you roll all that money into the $400,000 purchase that comes out of the escrow account, and then you don't have a tax bill that comes. But although then if you sell that $400,000 home, they will go after the depreciate, because that depreciation just rolls into the new one.
Mm-hmm.
Okay, so when you're depreciating the 400,000, you're not depreciating based on 400,000. That depreciation that was brought in from the previous one gets factored in to how much you're able to depreciate, if that makes sense.
Yeah, it does. But the same principle still, if you continue building upwards, really, because you have to buy a property that's more than what that one, if you're to do the 1031 exchange, more than what that previous one that you're selling is worth, correct? So, but technically you can just chisel your way upward into properties and then go back to leaving it to your kids.
100%.
Why? And another reason why it's a great opportunity for a long-term investment. Not only could you possibly get cash flow today, but you could also make sure that you maximize the tax benefits to leave your kids the most money possible, so they can do good on this earth too. Correct?
Yeah, absolutely.
Beautiful.
1031 is it sounds great until when you get to the point where it's like, trying to find something to buy.
Mm-hmm.
That's the problem. But if you've got something you want to buy and then you can sell yours once you identify that, that's probably puts you in a better position, because the hardest thing right now is just finding property to buy.
Sure.
It's just, at least in our area, there's not a lot of options, especially when it comes to multifamily. You go to Chicago and there's a bunch. But around here, there's just not a lot of multifamily units, like 4 units or 6 flats. So it's just
they're gobbled up so quick. I feel like, and I go back to, like, a lot of people want to be investors now. The bigger pockets, community. I feel like I see a lot of people that just are coming into that, like, I want to be a real estate investor. And I feel like that it's maybe made that market a little bit more crowded than it once was. Like at probably 2004, when you got into the business, to now, there's probably a lot more investors now because of communication like that and people learning. Would you agree? Like, is that part of the lack of supply?
I mean, I think as an investor, the problem is you're competing with the overall market right now.
Sure.
Too. There's just too much demand in general. So not a great time to buy when there's a lot of other buyers.
Sure.
So if the market starts to turn, that would be a good time to buy. Although keeping in mind that in real estate, if you like, when the market started to turn in 2007, it wasn't until 2012 that things bottomed. So it took 5 years for that to play itself out. So if the market was start to turn and prices were to go down, likely they're not going to go down just for 1 year. It probably will be a sustained downturn for a period of time, depending on what happens with the economy.
Sure.
I'm not saying that's what's going to happen, but you can really.
But it could.
It could.
Yeah.
We have a clear view into the future based on analytics. If I knew then what I know now in terms of being able to see what's going to happen based on supply and demand, I would have bought a lot more property during the downturn. And it was a competitive environment from an investment standpoint, but there were properties that were selling at 80,000 that I was like, no, they want 81. Nah, I'm not going to do it. And
now
it's like I'm beating myself because that place is 250 now.
Yeah.
So I bought a decent amount during that time, but boy, I wish I would have bought a lot more, because not only did it appreciate, but the rentals values shot up.
Yeah.
Well,
if you're a newer investor, what advice would you give? You have 2 to 3 tips for new investors. What would those tips be for the investors to make sure that they cross the T's, dot the I's, to make sure that they're doing this right and they're just getting started? What would those tips be?
Yeah, I mean, so first would be, we sit down and do a very thorough examination, get a clear view in terms of how this plays out in reality. Because they're
not on the Bigger Pockets podcast.
Right.
Let's get real.
Let's get real. Let's really look at the numbers and look at what's available and get a realistic point of view, and then dream, but let's look at realistically where we're at now and what it takes to get where you want to go. Put together the roadmap. So that would be number one. Two would be, okay, once we figure that out, let's talk with a lender to see, what type of loan programs, because you can buy, a 4-unit as your primary residence as long as you occupy one of them, which will give you a lower interest rate and a much lower down payment. I believe you can buy some of them FHA financing. So you put 3.5% down. So you can put a really low down payment down if you're going to live there. So
that'd be something like a 4-plex, something like that,
Yeah.
where somebody lives in one, rents out the other 3.
Exactly. Yeah. Or lives in one and rents out the other if there's only 2. And so there are great ways to really maximize your investment there. So we talk about those options, but financing is really important. Get an idea of how much money you have to put down, and then having some sort of budget in case things go sideways, or depending on how much work you have to put into the home when you buy it. So that would be probably the second most important thing is if we feel like, okay, this is something that you want to do, now let's get a lender involved and really figure out the details. And then let's see what else. I mean, then start shopping. Everything else kind of takes care of itself.
Those foundational pieces are in place, right? Your financing set, you understand the vision, the work that's going to go into it. You've already started talking about areas type stuff. And
start one step at a time.
Yeah.
Does it make sense? Okay. How does this work with you? Do you make enough money to be able to afford what you want to do? And do you have this down payment and extra funds in case things come up? And then, then let's try to really hone in on the area, the type of property, and some options, and then get a good feel for, how this would actually look as we start looking. And then, of course, there's the questions about, LLC, or, rentability of a home. We talked about management. It's also important to know that property taxes are going to go up a little bit. So you might be looking at a property tax bill of, $3,000, but it might be $3,800 because there's no homeowner exemption. There's no exemptions on there, so you lose that. So it actually the cost that you initially calculated will go up a little bit. So, but those are all things we as the broker will help them out with.
Yeah, we'll help them kind of see that before they see it themselves, especially in the beginning. So, all right. So if you're looking to invest, it's important to look at it from a big picture. Do you have enough money? Look at it from a capitalization rate to make sure it's a good return on your investment. Get a lender involved once that part has been kind of worked out. Understanding that real estate investment is a great opportunity for long-term investments, a great opportunity to be able to leave your family wealth without getting that huge tax hit that you get if you were going to sell here today or during your lifetime. What other things should people know as we get close to wrapping up? What should other people know that are getting out into the real estate investing world that maybe I didn't ask you, or that maybe we haven't talked about yet?
I think we kind of touched on with the what this actually takes to do it, so you don't go into it thinking you buy it, you slide a renter in there and then sit back. It's going to be work. And in my view, the biggest pain point for me has always been getting a new renter in there, making sure you get the right person. Thankfully, I've had really good renters. I've been doing it for almost 20 years now. There's been times where there's been some issues, but never had to evict anybody and was always able to make things work with situations. But it's all on the front end. You got to make sure you get the right person in there, meaning, I like to really look at someone with great credit, at least 650. And I like to make sure that their income is very good. They don't have a lot of debt. And we'll help you run credit checks so you can kind of see what their debt to income ratios are. And, if they are maxing out on all their credit cards, that's a red flag. If they've got under 650 credit score, there's probably some reason behind that. I'm one that I really don't like to listen to stories, because you'll see that a lot of people have great stories about why they're in certain situations. And that, not to say that anything about them, but I like to take the easiest path forward and deal with the highest probability of this being as easy as possible for me and getting the payments coming in every month without question. So that's really, it's setting the expectation of, okay, yeah, even if you do everything on the front end, you're still going to get calls. You're still going to get things that come up when the lease comes due, which sometimes can be every year. The person says they want to stay longer, but they don't. Now you have to find a new person. The process for that, how you're going to market it, if you're going to do it yourself or hire a broker to do that, and the really figuring out who's going to be the best fit for that, and kind of that process, which we help our clients through, and then getting them in there to take possession. And it's not always that. If you look at a property, you want to allow some cushion between what the monthly rent is and then what you're actually getting per month, because there might be a month a year that no one's in there. I try to really shorten that with mine to like a week or two, to have a really quick turnover. And thankfully in this market, it's been strong where you put it up for rent and it moves quick. But if the market was to turn, you may not be able to get the same rent. So you want to keep that in mind, that rents could come down. They certainly did during the 2008 era. And
protect yourself.
You want to make sure that, you have plenty of cushion in case that happens and you're not at a place where you might have to have foreclosure on your hands.
Yeah. Awesome. Well, that's great advice. And if people want to start getting into real estate investing, they should probably call us at Royal Family Real Estate.
I think so. That's probably a good idea.
I say, don't call anybody else. Call us, man. So, good conversation today. I look forward to leaving it off for the next time. More, investing tips as we continue to evolve. So, looking forward to those shows. As each day continues, and whenever we decide to launch that. But awesome, man. For today, let's wrap this thing up and let's let people have their time back. But peace out, everybody. If you're looking to get involved in investing in real estate or just need help as for a real estate guide to help you with listing or buying, hit us up at Royal Family Real Estate. We appreciate you. Peace. Sure.